very interesting week here. And what happened to this? Now that's weird. Um, that's gonna bug
You're
me.
live.
I'm ADD on this. Just a second. Oh, it has the daily on there. Okay, whatever. Um, yeah, like I was saying, it's not looking good for the market. Um, However, certain things show me that it's going to start changing. Uh, and again, we got to remember always have in the back of your head seasonality. October is a 50-50 kind of a month, and sure enough, we had highs, and I had quite a bit of a low. Um, if we would have had the monthly lows at the beginning of the month, you would have done all right. But when we hit this high right here on, I think it was the 14th, the 12th here, um, I recommended people getting the monthly low, and here's why. Here's you would have had your stop loss, what I said, just above it, and you would have made a lot of money. um, yeah, you might have, like what I do. I scalped. I didn't take it. If I only if you guys listening on this Saturday morning thing, when I usually say that stuff on Saturdays, my view for the week or whatever, this and that. Um, I usually say stuff like that, and I don't listen to my own advice. But if you do, here's what you do. If I say something like that, and then DM me or when I'm in the stream during the week, say, Ron, did you get in those in that monthly low thing that you were talking about? And I say no. 95% of the you have a very strong chance that what I said is going to happen because I didn't get into it. Um, so yeah, that was a pretty good trade. So with that said, what do you guys got for me? It's Q&A time, so please turn your mics on unless you have something in the background, um, and fire away, ask questions, talk. Um, we'll go from
Dunks, you're
there.
up.
Good morning. I had a question about your CCI indicator. How do you use that to, I guess, trade spy?
I really don't use it on the spy. Um, let's see. I think I have it on. I No. I told myself I was going to do this, and here we go. Yeah, I took it off. I mostly use it on my VIX indicator, but it's the same thing, same strategy that I use on the VIX that I do on the SPY. You have to be really patient. You wait for both to be in extremes at the same time, and not a little bit off. They have to see, like right here. This is in extremes. This is just coming into extremes. This came out when this bottomed out right here. So typically, what you do is you wait for both to be in extremes, and when they are and break out, that's a sign that it's a good entry. So right here, you might have gotten stopped out, came back in again. You get back in it on the breakout, and boom.
Okay. Thank you for that.
Yeah.
I'll let somebody else go next.
Um, you could do that with the stochastic. You could do that with the RSI. They're both momentum indicators. So, and again, like I tell everybody, um, you don't want to have a bunch of indicators that tell you the same thing. Okay. Um, slow stow's a momentum indicator. Um, and the MACD is a trend indicator. So they
Hmm.
give you different information. So, um, and this is why I you know did quite well on Friday on the big drop. I did very well on it actually. Um, it if you know, let's see if we can get it down here. Here we go. So here's where we were at the top of the channel, which I drew from here to there. All right. So already before the bell, I had this channel up. Okay, that's why extended hours are pretty important, and channels are important. Now, this is just the channel line that could break through, a move right here, but the trend line cannot. That's got to be unbroken. Okay, so because that's the trend. And wicks are extremely important. Okay, so because that sets the trend line. All right, you could have both to give you an idea. You could take wicks off and just do the bottoms, or the tops, or for support line the bottoms. But you definitely need both. Well, wicks are very very important. So it set that trend right here. Hit the and hit the top. We could have played this right here, but that was everything was going down yet. But then right here at 10:15, we had the MACD in a big divergence pattern right here. We're in lows on both the CCI and the slow stow. And the beauty of the ADD, the advanced decline, we had a big bear flag right here. It's funny, we were talking about bear flags all day, pretty much Friday. And I said, okay, we broke the ADD, right? Everything was just begging to break, and that's when I got into the puts, and I took my fib off, but it came down, hit the second target, bounced right off of the 4 hour channel here. Again, yeah, this kind of looks like a mess, but I could hover over thing. Oh, that's my 4 hour top. Oh, that's my 4 hour bottom. I know my colors. Which is which. The 15, the 15, which I have to change now. The 15-minute channel here, it was ranging. I have my monthly low here, so I know there's going to be quite a bit of a fight. But once that broke, it was boom. Next thing down was the 4 hour channel. Perfectly hit it. Um, so pretty easy ride down uh, Friday.
Can you
But
go over how to fibs for everyone that doesn't understand them or is new here?
Yeah. Before before you do that, Ron, I got a question before I forget. It's regarding the wick. So you mentioned wicks are very important, and I realize sometimes on the fib it will wick up there on the 30, but the body is not closed over
yep,
that reversal,
yep.
even though the wick up, but then it pull all the way back down. Does it tell a story that hey, after a while it might go back up there and close above that 38 reversal zone.
Yep, and there sometimes, uh, especially in days that are really volatile, fib training is or fib trading. My strategy, not just mine. I got to give credit to Connor Polifroni for that. And if you guys don't ever watch his channel, you really should. He is indicator holic, like kind of I am. We, you know, do a
Are you
lot of
guys
things.
family run?
No, 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 no.
Because the
No,
reason I'm asking, he got similar sense of humor as you, so I was wondering if you guys are related.
no,
I'm just-
no,
okay.
no. We just acquaintances. We did some work together a little bit on the Fibonacci trading and helped make automatic fib uh, indicator that puts everything on there automatically. I we did it just to have it on there, but we ended up, I think both of us like doing it by hand.
Would you have to rehearse that upstairs? I'm telling that.
It's fine.
Um,
Sorry, bro. Like I tell you, I yell because can't get it through you.
It's nothing.
Can't get it through you.
okay, sorry about that, guys. Um, yeah, my computer screens are acting weird today, so I'm having a hard time pulling things up right away. Gotta do it this way. Here we go. Okay, so
Thinkorswim's under maintenance too, Ron.
no, Thinkorswim has nothing to do with it. This is a computer system deal, not Thinkorswim. So, but getting back to volatile days, you have to be careful with the fibs, and you have to be really disciplined. Um, and unfortunately, with the fibs, you're not going to get in at the top, going down or vice versa. And if you heard me Friday, I even said that they're really screwing over the fib traders as far as this strategy is concerned.
Yeah, you did say that.
Yeah, because the way things were working. So here's the opening the opening fib here. I go from the open back to yesterday's close on the 30-minute chart. So I got this on the 15, just a second. Okay, so here's the 8:30 for me Central Time. So there's the 14:30 right here. Okay, so that was yesterday's close. Okay, I'm getting some feedback from someone. Yeah, you guys gotta mute your mic. It sounds like someone's in a car or something like that. So the with this fib right here, we had a target, up here, and here's the reversal zone. Okay, so with that context, we came way down below the reversal. Okay, so you're tempted, and you can. There's nothing wrong with that. This gives you a feeling. Okay, we're messing with a reversal right here. Okay, now we broke above. Right. I think at the beginning of the day we started coming up. Right. So this is why I say if you if right at the bell, if here's your target. So I show people I have this target up before the beginning of the day. I'm on the 5 minute mark, and I already have this up, right? So generally within the last 5 minutes, you kind of get a close estimation of where this fib target's going to be. I was saying 415s the first target, um, and then at the bell, then boom, it's set, and then I know for sure, and I already have my targets up. Okay, um, but it's I recommend if you do that, if you're like, okay, 415 is the target, I'm going to get 415s right at the bell. Um, a lot of the times it works, and you hit your target, you're good. But a lot of times this happens. Okay, so you have to be prepared for being stopped out right away, and you could have going by the 30-minute chart, your stop would have been down here. So seeing that's part of trading your planning your trade. That's a big stop loss, right? Uh, Especially if you see a bearish hammer like this, after a decision candle here, big topping tails. Um, you might have had your stop right here if you're doing that. Um, but when you have that kind of strategy, I don't put a lot of money into it right away, because this could just kill you. So if you put a little bit in, you get stopped out, no harm, no foul. But then you could come up and you can make some money right here off of this, off the small amount. Or once you break. Now for this instance, you had not that much of a risk to reward here. Okay, usually when there's a bigger gap, you don't have topping tails right behind you looking back. Let's say we had a nice small run up like this, you know then it'd be a pretty good bet to have this kind of strategy to get in right away, to like you had this run up here, and that would be your target right here. And so your stop, let's say this candle is down here, that would be your stop. This is how you properly have a good trade, guys. You only want, for me, I'm around a minimum of 1 to 4. All right, a lot of really good traders out there say 1 to 5, 1 to 2. Those are more for scalpers. Nothing wrong with that. One of the best scalpers out there that I have a ton of respect for is Jared Wesley. He does 1 to 2. Sometimes he does 1 to 5, but they call him the scalp master for a reason. He does very well with that. But however, if for me, I just like I like bigger targets, so it keeps me out of those kind of trades. 1 to 1.5, 1 to 2. They're a little bit more riskier as far but that should be your bare minimum. Okay, and if you have a stop loss this big, like let's say 40 cents. Now I'm just making this up. Don't pay attention to what the prices are. I'm making this up. Let's say your stop loss is 40 cents, and your first resistance is only 10 cents, 20 cents up. That's an absurd trade. It's dumb. It's really stupid. Why would you risk twice as much as your reward, right? So when you set something up, none of this is here. Let's say your stop loss is 10 cents, and your first target up is 40, 50 cents. That's a 1 to 5 risk reward ratio. That's what you're looking for. Okay. Well, why is that? Well, the the way to trade, the successful traders is all in risk management. Okay. So if I tell you to flip a coin 1,000 times, a quarter, every time it comes up tails, you win. Every time it comes up heads, you lose, right? Okay, if you have a good entry, right, and you plan the trade, and you're like, okay, this is a good one to, let's say 1 to 2, all right, bare minimum 1 to 2 risk reward, and that's all you trade is 1 to 2 risk reward ratios. Now it obviously I'm presuming you have a good entry. Okay, that's something you have to learn too. You have to have certain rules set up. You have to look and see where your risk is in the reward. So in a good entry, you don't like right here. Oh, I'm going to get into calls right here because we're so down low. Well, that you could say, okay, here's my risk and here's my reward, right? But that's a foolish entry. We're in a huge downtrend, so you get stopped out right away. So if you do that every time, you're going to lose every time, right? So under the assumption you have a good entry, 1,000 times, you're going to be successful on average 50% of the time. You're like, that's not really good. The best traders out there do very well at 54 to 55%. That's it. That's their win ratio. Okay. But here's the thing. If you flip that coin, and let's say every time it comes up heads and you lose, you risk 1, right? That's your risk, right? And your 1 right here in this instance is, like I said, like 10 cents in this example. Okay. But every time you win, you get 40 cents, right? So if you do that 1,000 times, you flip a coin, you're 50-50. But every time you lose 10 cents. But every time you win, you get 40 cents. So what happens after the 1,000 times? You're up a lot of money, right? That's good trading. That's how you become successful, is planning your trade, trading your plan, and assessing your risk and the reward. Now, getting into, like a momentum play, like, here's your target, and let's say we're coming up here. So here's your target and or your resistance, and here's your first target, right? So if you're in right here, that's barely a 1 to 2, okay? But momentum is a little bit different, where when you break and you have, let's say this isn't here, and your first target is way up here, okay? That's really a momentum play. You're basing it on pure momentum breaking, resistance and coming up here. I used to do that for a long time. I was a big momentum player. Did very, very well, especially in OCTs, doing that. But the market for the last 2 years has been really horrible for strong momentum. So buying right after it breaks resistance, that you got to be careful with that. I don't recommend it right now, but is that Jim? See, on live streaming, I can't see everybody's names. So Jay, whoever that is, you gotta mute your mic. There you go. So, why, right? Especially momentum plays now. Oh yeah, well, plenty of times I make 10%, after a break of resistance. The momentum, I don't even get into plays a lot of times. Pre-market momentum plays. Real momentum is, it's already up 70%. Not 10%, not 20, not 40, 50. I'm 70%, 100%. I'm not into it until it breaks resistance, and it goes up 800%. Those were the good old days. This now is just garbage. So I don't. Those plays are just. I don't advise it. I think it's irresponsible. But why buy going into resistance instead of here's the top of this channel here? Why get calls instead of puts? Right, you're at the top of the channel. This just happened last week. I think it was right here. So someone made was saying if it breaks here, I'm going to have this level right here for a target. And I'm like, that go ahead. Hey, you're at the top of the channel here. I'm getting puts. Well, guess what? Right? Yeah, part of really good trading, guys, is to know, first of all, the market. Not just like lately, as in this week, but the last few years. These breakout plays just aren't worth it. You're in a down channel. Now that's what the market's doing lately. Bigger the channel, the more resistance. This is a 30-minute channel here, and we broke to the south side. I don't think it was right here. It was somewhere else. I can't remember, but that's just the example. If you're at the top of the channel, easy. Why? Little risk. You put your stop loss right above the channel, and then you set your target wherever it's going to be, and you get puts. If you're at the bottom of the channel, you get calls. Very, very simple. So I don't know how we got onto that rant by talking about fibs, but sorry about that. So with the fibs, getting back to that now. So yeah, the momentum. So we broke to the downside, and now, like what we were getting back to, here's the reversal, and now you're tempted to, okay, we're going down, because we broke. We're now bearish. However, it finished above. And on this candle, I told you guys is that we're still bullish on this, even though we're in the context we have this right here. Okay, and that's just the way things work sometimes with the fib trading. So then, however, that's the end of that. That's the end of the 30-minute candle. So you refib to the end of the candle or the opening of the next. Okay, and that changed things, right? So now here's your target. The fibs do not work well when you have a really small channel. That's just the way it is sometimes. Now from here, but this is what I did. I cheated a little bit, so we still have a bullish play, even though we're bearish right here. So I think I even did it before this open right here. I fibbed back to the previous high, and we came up to the top of this channel right here. Here it was at 10 o'clock. Again, top of a channel, get in. Here, right here would be your stop loss right above that. So I'm risking from here to here. Sorry about that. Let me bring this up. So I'm risking that much, right? To gain that much. You think that's a smart trade? That's like a 1 to, I don't know, figure it out visually, maybe 1 to 8, 1 to 10 risk to reward ratio. Easy. Easy trade. We're at the top of this. Oh, no, that channel wasn't there yet, so it's about right here. So no, it was here. Here to there, it was going up. So this was darn near top of this channel. It was the top of the ascending channel. It was also at the top of the descending channel in a bearish market. I'm getting puts right there, not calls to break upward. Just stupid. Here's you're risking all of this to make that amount right there. Why do that when you could have a risk right here and your reward this big? Easy trade. But again, this you really didn't fib here until refib until it broke right here, right? So more experience you get, more you'll play with the fibs before they break and things like of that nature. But here's the break. So you still remember, you don't break from, you don't fib from the candle, you fib from the fib break. Okay, and that gave us our targets down, and boom, hit the second target.
Could you
So,
show
Ron,
how to do that on TradingView?
Yeah.
Because not everybody has Thinkorswim.
And Ron,
TradingView is the same thing.
Okay.
Yeah, it's just your Fibonacci. Now, the fibs look different, but they also look different on Thinkorswim. Is just a default, everything's red, right? But I changed mine according to, let's see if I bring this up here. So the default for me is 0 and 100. Okay, I don't really care about the 0 and 100, but I have these. This is bright green because it's really important. This is your trend reversal. 50% I have purple. That's pretty important. And then the golden pocket, 61 to 78, is your reversal area for dip buys, right? And then this is your target right here. So first target is really important. So I have that bright yellow.
So, Ron, do you, since it's a 30 minutes rule where we're using a 30 minutes candle, do you wait for half a body, full body, or just a barely body going over that 38.2? That's what I'm trying to figure out.
To do what?
To refib. Like, the 38.2, since if that breaks, then we refib from that line. I'm trying to figure out, what do you call a break? Half of the body, full body, or just,
The
that
close.
body barely going through?
Nope, the body has to close below that line.
The entire body or just part of the body?
Nope, the close.
Okay, the close. See.
You know, let's say that the reversal zone is right here, right above that blue candle, or below it. Okay, that's then you refib because it closed. It well, yeah, it closed above your reversal. If the reversal was right here, right, it broke it, but then it came back below it, so you don't refib. You only refib if the candle finishes above the reversal. See, so here's the reversal zone right here, right? This broke below it, but it closed above it, so no refib. We're still bullish. Right here again, still bullish. Right here again, still bullish. And of course now this doesn't happen all the time, but again, when it's really volatile, that's why I'm saying trading fibs a lot of the time, not all the time. It's awesome when it doesn't do this, but a lot, your candles are bigger. So right here, you're so bullish, all of a sudden, boom, it just crushes it. It just doesn't barely close below it. Boom. So now you already missed a lot of the move, right? But that's what happens sometimes with volatility. So you're there's your new fib target right there. So you missed a lot of this move right here if you're solely going by the Fibonacci, my Fibonacci strategy. What a coincidence! The first target was right at the monthly low. Funny, second target right at the 4 hour. That's right. I got out of my puts. That's called concurrence. When more and more you have that line up, that's a strong indication right there that you might be done. So that's how that works. And that, again, perfectly. But with the fibs, though, see, you weren't in until right here. So you missed out on the bigger move if you didn't have your channel set up. But still a very, very good, the fib still gave you a really, really good play right here. But a lot, what does happen, what's really nice is it just barely breaks, right? It just breaks down below here. Your next candle starts here. Now you've got a smaller, without these massive breakouts, a smaller candle. Now you have a small risk to reward. That would be like right there, a 1-to-7 risk to reward ratio, right?
Hey Rambo, good morning. This is Papa. I have a question.
Yeah.
First Feb, what is your consideration like a previous day close and the pre-market low?
Previous day close and pre-market low.
No, how do you do the first Feb?
The first fib?
Yeah.
Yeah, it's from today's the days open, and you go and you fib it backwards to yesterday's close.
Oh, okay.
Can you give an example for them?
I just did one.
I know you did, but maybe refresh that.
So here's the open for me, 8:30. The open's right here. And you fib and you go back. And now this has to be done on the 30-minute candles. You're tracing, well, you could fib on the 5-minute, right? The open from the 5-minute, but it'd be the closing candle. So it's the opening candle, the open to yesterday's close. So on the 30-minute, that would be this candle right here, and it ended right here. So that was that close. Open to close. Now what I meant by the 30-minute is you play the strategy from the 30-minute candles. Okay? Your rules are according to the 30-minute candle, not the 5-minute. Right? The 5-minute can break down the reversal area and finish below it. So you're like, okay, I'm in puts, and then boink, this happens. Okay. You have to wait for the 30-minute to break below. Okay, now you're like, well, this broke below. But after the 30-minute candle, right? This is your first fib of the day. You always, at the end of the first 30-minute session, you refib to the open of the second 30-minute candle, which is right here, right? So see how that changed the target and it changed the reversal area? So again, this dipped, it perfectly touched below it. This one broke it, right? So then after it broke, there's your entry. This would be your, well, actually, your stop loss would be right here. And your first target would be, I didn't refib this break yet, but it was down here.
Yeah, got it. Thank you. And my second question, if you don't mind, the refib, you are doing a second 30 minutes candle open, that too, from the 38.2 fib.
The 38.2 fib is the reversal. Okay, so if it breaks and holds, the 30-minute candle breaks below that, then you refib not from the candle but from the 38.2. Let's say it broke to the bearish side, which it did. You refib from there to the previous high of the day, not pre-market, not yesterday, but of the day.
But remember, guys, that's only if it break that 38.2. Only.
No.
Then we refit, right, Ron? No?
Not if it breaks. If it breaks and holds. If it closes below.
I missed that part.
Yep.
Hey, Ronbo, this is Aladdin. So I remember the second fib was the close of the current day's 30 minutes candle and the close of previous day, right?
Yeah, the second fib is the close of the first 30-minute candle.
Right.
So you have your opening, you have your first fib, which is the open to the close. The second fib, to redefine it, I guess, is the close of the first 30-minute candle to yesterday's close.
Awesome. And the third fib, I guess, if it breaks the 38 mark, then we refib, just to kind of gauge the next movement.
Yep. I call it cheating because you are kind of cheating, but yeah, let's say we dipped down right here, came back up, and I don't know where it is. I took it off now. Um, but you start getting a feel for a bullish or a bearish move, right? I'll go down to the 38.2 right away and go to the high, right? So here's the high. Topping tail, higher high or lower high. I'm getting a feel, and of course the channels. That's why I think they're so important because they give you idea what's going on. That we're going to be bearish. I'm refibbing right away, but that takes experience and a feel for things, right? Just one little bearish candle. Let's say it didn't look like this, where it was, we're coming from up above. Then that doesn't concern me. But if I see the momentum, coming down, I'm gonna cheat a little bit and refib just to get an idea where the target is, so then I could get my option up and see what that bearish target would be, and to get that strike price.
Right. Awesome.
Yeah.
Yeah, it seems like waiting for that first 30 minutes candle to close run is kind of a good idea for, like, let's say a inexperienced trader that's learning, just to give them a feel of, okay, that first 30 minutes of the market, what it want to do,
Yep.
to actually yeah, just to give you that sense of relief,
Yeah.
or
Yep.
yeah.
It's trick. No matter what, when it's volatile or when it's ranging, it's it's difficult, and you have to be pretty experienced with it. Because fibbing, there's something in our psychology. We see a target, and no matter what's going on, oh well, it says the target's here. I'm getting in, right? So, and you could really mess yourself up there if you don't know what you're doing. If you don't know where your target, if you haven't done any kind of homework, or you don't know how to, what your entry is, you don't have any kind of a plan. New traders do that all the time. They just, oh, someone said this is going up, so they don't even look at the chart. A lot, boy, yeah, they just have a phone, and someone gives a target, and they get in, and they have no idea what's going on, right? And then right away they're bag holding. No information, no, studying to see if it's a good position for them to get in. Risk to reward ratio. They don't know where the lows are, where the highs are. It's you're better off just going to Vegas and gambling. At least you're going to have fun doing it. That's yeah.
I have a quick question. What should we look at when order blocks come into play?
Um, as far as what, like an order block was set right here, or right here, right here. Well, you could see them as potential targets. The point of interest is more important really than an order block. But what I mean by that is, what creates the lower low. So, and this also creates your range. Okay, so this high right here, this candle created the new low. So as of this point, I told you we had a really big range coming into Friday. Right, the range. This was the range. Boom. Right, so technically we're with momentum. We're yeah. This obviously, well, I don't want to get too much into it, but here we have a higher, a lower high, a higher low. Now right here we set a lower low, so now we got 3 lower lows. Okay, so where's my target? It would be right here, right? Because it technically it broke right here, so it broke up, so that would be my target. This I believe was an order block right here though, so your fair value gap, if I remember, I did set one right here. So fair value gap, if you guys don't know, is any gap between 3 candles. Okay, so here, and that includes wicks. Again, wicks very important, right? So here's an order gap. Here's a fair value gap right here. Here's another one right there. Here's your order block. So we made this high. We came back down and came back into this order. So here's an order block. So see, they are targets. Fair value gaps give you kind of an shows you where the momentum is. Nothing and nobody can create these except for big money. Okay, I'm talking institutions. So they drive it up, they short it out, and then boom, from here to here, another order block, bullish, right? So you want to look at the fair value gaps, but order blocks, very important. But you could have order blocks within within a move, right? And what do you mean by that? You know, well, remember the market structure is fractal, so so within all this is the 30-minute chart. You got the 1 minute, you got the 5 minute, right? Creating all of this stuff. So order blocks, I really let's see here. Here's I don't have the 4 hour on mine right now, but you can do like order blocks off the 15-minute mark or aggregation, and then you could go down to the 5 minute, and the 15-minute would be your bigger targets, and so you're watching, like right here is your target. Okay, so on the 1 minute you have a big order block down here, and on the 15-minute you have an order block right here. And so we come up to a certain area. Let's say there was an order block here. Now this isn't really a good example, but this could have been a run up to this order block right here, and from here your target is down here. Well, it's like, well, Ron, that's the support area too. Yeah, a lot of times support, you know, your order blocks are support and resistance areas. So that's another way of looking at it. But
that depends on if it's a bullish or bearish order block.
I don't look at order blocks as bearish or bullish. They're just that's where there's a lot of liquidity.
Okay.
Okay, so they're like magnets. Okay, but the points of interest are what creates a bigger the going from bullish to bearish. Okay, what creates a change of character? That now within that move that creates a change of character, you could have order blocks in between that, right? But so that's why they call it a point of interest. That's the most important spot, would be right here. So now, really, you got to keep an eye on the high, all the highs and lows. Right now, what considers a move to create a higher high, higher low, or lower low, lower high? At least 3 candles. Okay, so before I would draw like these lines right here. So boom. Let's say this move up only was 2 candles up and then started coming back down. I just don't care about like kind of like this. That this still was too. Like right here, 1 candle up. That isn't considered, a pullback or anything like that. So I'd come to here, come to here. That mitigated this, so you could have a lower low, lower high. That mitigated that. That made that move down. This move up, that mitigated that. See the pattern? Came up. Uh-oh. That didn't mitigate. So guess what? Boom, 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 boom. Look at where the wick came up. Now that's a ghost wick, so I don't know how you're gonna play that technically. It did break that to mitigate. So I personally I don't use that ghost wicks for mitigation. So that's just me. So right now we didn't mitigate this area as far as I'm concerned, and we didn't mitigate this area right here. So usually a big smash through the low like that is this could be a liquidity grab. I don't see anything over here. I'd have to go back and look, but let's say somewhere there's some liquidity going on right here, right? Like this area right here. These are all zones of liquidity. A lot of up down consolidation, whatever you want to call it, compression, blah blah blah. It comes down here to then make a move up to mitigate this. No matter what, if you don't think this is, this candle mitigated this move, fine. You still have this area right here to be concerned about. You could call that a gap if you want, like if if you're familiar with gaps. You could call it a gap if you want and treat it like that. But like gaps, they don't fill right away. Oh, we got to come up here this week. No, we don't. We could fill that 3 months from now. There's still gaps, guys, from I believe last October, last year, at if I remember, 365. You're like, holy crap, Ron, what, that's kind of scary. It's like, well, I'm not too scared about it. It's just
be prepared for it.
Yeah, see, more you just trust in the charts. You don't care about if it goes up or down. You just want to be going in the. Look at that right there. Did that mitigate? Came up, came down, came up, came down. That mitigated. Boom, boom. See, the move that broke this was right here. So technically, I just don't agree with that. This is the move right here that broke this high, right here. So here's the high. This move, see, right here, it should have came down. See, now, but here's this thing. Some people say that right here, down here, mitigated this right here. But the high of the move really is right here. You could possibly say right here. I just don't see that. I think that this move right here hasn't been mitigated yet until, funny, right here. So these are order blocks, liquidity, whatever, you know, all kinds of stuff. So this is 418. Funny, came back down, mitigated that area. So we could be, like I said, November, seasonality, it's just, I think the second most bullish month of the year. Boom. It could be done with this big bearish move and we continue upward. Possible.
I have one more quick question.
Yeah.
Which time frame should you use the Rinkos on? I know you said the 30-minute for your fib, but which time frame do you normally view Rinkos?
Well, again, TradingView is different from Thinkorswim. Thinkorswim, it doesn't matter. The yearly chart, if you have 50 cent or tick in this, really the tick is cents in this thing, but 50 tick Renko on the hourly is going to look exactly the same as the 50 tick on the daily or the 1 day. Okay, it doesn't matter how big your chart is. The Thinkorswim, you're confined by the chart you set it at. TradingView's weird that way, and they're Pine script based, so you could have a 3-year 1 minute chart if you want. I know there are certain limitations to it. I'm just for hyperbole's sake, but the 1 year. So I just so I don't have 5 billion bricks on there for my Rinkos. I have 20 days at 75 ticks, 20 days for 45 ticks. I also have, and then I have just 5 days, 25 ticks. So 25 cents is what my default is. So when I come up here and hit my Renko, see, I used to have a 1 year on here, 1 year, and what I do with the 1 year is the actual average trading range. So if the average trading range is, $5.50, I come up here, time frame, 1 year, and I'll go 525. And that's what it looks like. That's a whole year.
Got it.
And the beauty of Renko, again, we come up, it's really easy to see market structure on Renko, right? How can't you draw this? High, low, higher high, higher low, double top. So this isn't a higher high here, or a high and then a low and then a higher high. This is just what I call flip. It's just nothing. This low created that high. In order for this to go higher, that's got to mitigate this high right here. And what did we do? This right here is called what? Inducement. It's just getting people sucked in. Oh, now we're going higher. Oh, we're going higher. And I'm going, we have to come back down here to mitigate this. Right? So that's the beauty of Renko. Very easy to see market structure. But so on TradingView, they do go by the time. Why? Because with Thinkorswim, you have to, it's just the way everything's programmed. You have to set the size of your bricks. And that size is the size of the bricks. Doesn't matter if it's the 1 year, the 3 year, the 3 day, right? If I have 525 ticks, right? And let's see when this was. This was October 25th. This was October 20th. So let's say I had the 10-day chart on Thinkorswim and I had it set to 525 ticks. This is what my chart would look like. Just these 3 bricks right here. That's it. Now on TradingView, it does it all for you. It's convenient, it's nice, but your candles are automatically changed for you by Thinkorswim to give you the average trading range for that length that you set it to. Okay, so if you, we're getting kind of technical here, but if you set your length to 50, what it does is it calculates the average trading range for the last 50 candles. Well, the last 50 candles, the trading range might be 25 cents. So then your Renkos are going to be set to 25. Okay. If you set it to the last 500, I don't know, there's got to be a limit, I'm sure. The last 500 candles, then it's going to change it a little bit more. Okay. But 500 what? 500 3-minute candles, 5-minute candles. See, because bigger your aggregation, the candles are going to be bigger, right? So on the daily, your candles are going to be $5.50. But if you go down to the minute, no matter how much of a look back you have, that they're going to be around, 15-cent candles. So your Renkos are going to be around 15 cents. So you have to be aware of that. That there's pluses and minuses to both. I mean, if you really got balls, you could go down to, the the 2 day, and you can have a $3, stinking Renko on there. There's your chart. One candle,
Wow.
right? That wasn't what I was expecting too much. It only moved. So let's say $1, right? So with Thinkorswim, you set the range, and whatever the time frame, it doesn't matter. Okay, so here last 2 days, it moved from 410.97 down to 409.97, $1. And this thing right here, that's where we're at right now. So if you have this set for $1, and let's say this comes down to here, that's why I'm saying it takes a lot of balls to do this. You're like, okay, if it comes down here, it's going to come down to $1, so I'm getting in right here, and I'm going to make a big $1 move. But the thing is, this could come down 99 cents, come all the way back up here, and then come all the way up here, 99 cents, come all the way back down, and it won't print another brick. Because Renko goes by range. Now if you go down to 30 cent, okay, there's your, now you have a lot more movement, but you also have a lot more noise. That's the beauty of Renko, is it cuts out the noise. Now, I thought it moved more than $1, but I might have. Yeah, there we go. Okay, I thought it moved more than $1 the last couple of days. But see, now look how little noise there is on this. Right, but right here, see, oh, there's a double bottom right here. There's a $3 move. Look at, you see all the resistance right here at 414.96. 1, 2, triple bottom. $1, $2, $3 move. You get in here, oh, double bottom. Now we're going to come up here and break this high, and nope. Right? So it's bigger the range, more dangerous it is. No matter what, I don't care what strategy you have, the bigger your range, bigger the aggregation, bigger the moves you're going to make. You're going to make the big massive moves, but also you're going to have a big stop loss.
Thank you, Ronbo.
Yep.
Hey, Rambo, I have a small question if you have time.
One more thing though before. So here's your market structure. That's not mitigated right there. Big crash down. Guess what? That has to be mitigated. Boom. We mitigated. So now we could break down to the next move down lower, or guess what? Unmitigated. That is a point of interest right there. Now there's an order block right here. Now see, here's the difference between order blocks. Order block there, order block here. That's not the point of interest though, however, that is. So we could easily come all the way back up here. All right, go ahead, sorry.
Yeah, no problem. Thank you. I see your chart for the weekly expected high and weekly expected low.
Yeah.
How do we calculate that one?
Do you have Thinkorswim?
Yeah.
Oh, great. Okay. So I don't know why these are so behind here. Okay, so here's the monthly, here's the weekly double, here's the weekly expected high, the weekly expected low, the double weekly, and the monthly is, oh yeah, we're we're below the monthly. Okay, so all you do, this is what I do every single day, at the end of every week, and once a month for the monthlies, right? So for Monday, right, October 30th, right here, you see that on the trading change?
Yeah.
It says 425. This is a proprietary thing that Thinkorswim has. So that's saying you're going to have a $4.25 expected move.
Okay.
So you do this at the end of the trading day, right? Every single day you do it for tomorrow. Okay, so 425. So you add 425 to 410.68. You come up here and there's your weekly. Then you add it to your chart. There's the weekly expected move. Now, then that's your first sigma. Second sigma is a double that. So 410 plus 410, 820. So it's right here. And then you do the same the other way. 410 down, 810 down.
Got it.
Okay, now that's for your daily. But now for for Friday, so you have 410 down, then 820 down, or whatever it is, right? So expect to move 425, double would be 850. That's it. So you do that for Monday, for Monday's move. But now what just happened Friday? We're at the end of the week. So what's the weekly expected move? Well, you go out Monday, Tuesday, Wednesday, Thursday, Friday, November 3rd, $9, and I round up, so $9.80 is the expected move for next week. So then you come up here and you're 980, and here's the double, 980 down, and here's the double right here. So I have to do that every Friday after the close to see where next week's levels are. And I mark them out here, 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 which gets things a little messy, but because I have my channels going. And then at the end of every month, sometimes it happens on a Friday, which is nice, but it's a pain in the butt because you got to do for next Monday, you have to do it for the week, and then you have to do it for the month. So at the end of October 31st, I'll come all the way down here. I'm looking at some options here. Then you go all the way down to the end of November. Actually, it would be December 1st would be the end. Or no, yeah. But this case you could do either. But November would be $18.90. So let's say today was the 31st. I would go $18.90 up, $18.90 down. I don't do a double sigma on a monthly move. It just doesn't happen. And that's where you get your monthly high and your monthly low, which for me is right here. So see, at the beginning of the month in October, or knowing October, like I said at the beginning of this, 50-50 month, it will have a high, will have a low. Wait for the high of the month, and then get the monthly lows. And look what happened. Boom. In 2 weeks, it went from 438 all the way down to 410. That's a $28 move right there.
Oh, super. Yeah. Thank you. Yeah. Now I got it. Yeah.
Yep. And now the importance of these, why? Okay, because on the daily moves, get rid of all this spaghetti. Here's your first sigma down. Here's your first sigma up, 414.92. Well, wherever it is. Can't be right here. That's the second sigma. Yeah, 414.92, the first sigma up. So let's say Monday it jacks up and goes to 414 area right here. What do you think would be a smart thing to do? Get a momentum play up and here's your first target up here when you're at resistance, right? And you're going to risk all the way down here to make that much? No. Why? Because these moves are sigma moves. They're somewhat like deviation moves for the week, or in this instance, the day. That's the expected high for the day. So once it comes up here, what do? You get if you want, this would, at that point, this would be, a lotto pick right here. But yeah, in the middle, just come back down to 413, in the middle of the two sigmas here. You got a good bet on getting puts right here, low risk, because if it jumps up, you're out right here. And then you have like a 1 to 4 move, right? Now the thing is, sigmas, you have a 68% chance that you're going to stay within the first sigma up and the first sigma down for the day, right? Look at all this movement right here, right? A little bit above up, a little bit back down below, comes up above, nope, comes back in. That's the whole point. You want to go with the odds. You want to trade with the odds, right? Getting momentum play here, you're at 38% chance that is going to come up here. You have a 68% chance it's going to come down here. You go with the odds. Now, sometimes I call it a blessing. It rips Monday and it just comes up and woohoo, we're I'm up 500%, whatever, and the week's just started. What do you think the weekly expected high, if you hit that on a Monday or even like a Tuesday morning? I'm getting puts. I'm getting puts pretty heavy, because now you're not the daily sigmas are one thing, but you have your weekly expected low right here. Here's the middle. 68% chance for the week it's going to stay within this range. So you're all the way up here. Easy money. Easy money to get puts. So everybody's getting calls. I'm getting puts. People are high momentum. Oh, we just broke this range right here. We're going to the sky. Or they're risking to come up here from right here, right? With that would be maybe a 1-to-1 risk reward. Not too bad in that instance. Why get 1-to-1 when you could get right here down to here? That'd be like a 1-to-10 risk reward ratio. Silly. It's contrarian because it's coming up here. The momentum's going up here, right? But if you got some kind of play like that, it's coming up here like this. Momentum is going this way. Well, guess what? That's why you have trend lines. Comes up to expect the weekly high, maybe pops up above it, and then all of a sudden, let's say it comes up here, 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 breaks out of the trend, sets in a head and shoulders. I'm loading up. There's my stop loss. throughout the, Monday, Tuesday, Wednesday. Right here, you're just in the middle of the week, right? Here's the expected low, here's the expected high. It just came down to the back to the middle, and you made a $9 move on puts. Easy trades versus getting in here to have it come up here, going into resistance back here. Why risk this much to make that much when you could risk this much to make all of that? I got 2 minutes and I gotta get going.
Be sure and check out his education thread as well, because he has a lot of information in there.
Yeah, thanks, Granny. Yeah, the education threads in there. If you do a search for a certain topic, you might find stuff in there. Or for my book/video that you could buy, that it's on there also. And then also you could go to my YouTube channel, Ronbo's Charts. You can find, I've got a ton of stuff on there that's not in the educational thread also. So thanks, Granny, for bringing that up.
You're welcome.
And yeah, a lot of videos that I have that aren't in the education thread are on my YouTube channel. How to draw trend lines, how to set up, deviations like this, right? These are extremely important. So I show you how you could draw these. You can make these by hand without using an indicator. Mine's a little bit more fancy. I got Connors. So that's why, if you do it by hand, every single chart is going to look like this. Your weekly, your daily, your 5-minute, everything like that. But with Connors, it's a little bit more complex for different reasons. They're kind of multi-time frame, right? So here's all the deviations on the 15-minute mark or whatever, and these are my daily deviations, weekly deviations, stuff like that, superimposed on the 15-minute chart. So this one gets a little bit more fancy, but that's it, guys.
Do you have, hey, before you go, do you have a good recommendation for deviations for TradingView at all? Because I've looked at them before and I just never really found one.
You have to make them by hand on there too, and they have one that kind of is like Bollinger Bands, or really Bollinger Bands are just a moving average, and then the deviations are based off of that moving average. So not exactly the same, but there are I think deviation channels, and then you just you have to make one for the daily, your 5-minute, 10-minute, and everything like that. But you have to go by channel, deviation channel, and then set up one deviation. Then you have to use another deviation channel indicator to have the second deviation, another indicator to make the third deviation, and so you could get it. That's how you do it on Thinkorswim too, by doing it this way. So I think TradingView, so even on Thinkorswim, you bring up the deviation channel, it sets up one deviation. So right here and right here. And then you have to bring up the indicator again, add a second deviation channel indicator, and you set that one up for 2 deviations. So then you get this one. And then 3 deviations, that one, right? Or these are 2 deviations. So very important though. Why? Because again, just like the sigmas, first deviation up, first deviation down, around 68.8% of the time it stays within these 2 sigmas. Second sigma's up, it's like 85% of the time it's going to stay within the second deviation. Especially if you go by the odds, you got like 99% chance it's not going to break and stay above the second deviation up or down below. Right? Look at that. Hit it, came down, but guess what? Finished basically right on it, moved back up. Came back up here, it actually held above, but the very next day, boom. And you could use this on the daily chart too, right? Now on the daily chart, it definitely breaks the second deviation up and down. The straight up odds are 68%. This is like 80 some percent. This is like 97%, and this is like 99%. It's not going to break the fourth deviation. So if it jacks up here, it definitely could come up higher, but it's not going to finish above there. Great time to get into puts if it comes way up here. Great time to get into calls when it's down here. Right, so
And that's when you get it absolutely the cheapest too.
Yep. Like I said before in other videos, right? First deviation up, first deviation down, dumb money area, liquidity, retail, smart money, buys here, sells here, buys here, probably sold some right here at the first deviation up because it got rejected, right? That's another thing about deviations. They act like magnets. We break, came down, came back above here, set a lower high. This kind of gives you an idea of where things are going, right? We broke above. Now, if we bounced right here, coming back up, then I'm thinking it's going to hit the 1.5 deviation. If we break that, then most likely we're going here. But look here, boom. We kissed it, and then right here we broke below it again, most likely coming back down to the average price. On the weekly, guess what? We hit it, came back below it. Oh, trying to fight to come back up to it. No, rejected. Probably back on the here's now these dotted lines are half deviations. They are very important, but they're not as important as the main deviations, right? So technically off the weekly, if we don't get back to 414.46, see, we bounced right off the half deviation right here. Right? So if we break 408.56, we're probably coming down to 394.78. 394.05. We break that, we could be coming down to 364.21. Right here, everyone's yelling bloody murder. Oh my goodness, it's the end of America. And then big money's going, oh, I'm going long. That's it.
Yeah, I've been looking for a good one on TradingView, and I haven't found anything quite yet. Similar to yours, you know. Is that a script you paid for on Thinkorswim, or?
Nope, it's free. If you want it to make it look like, if you want to do the free version, I have my video. You can watch deviations. I think it's called Find the Pivot or something like that. Okay. You can make it look like this for free. All right. I don't think this is the free version. Let's see. No, I got the deviation system here too. So, but it looks just like this. You come up here. I think it's just deviation, standard deviation right here. And you'll have to use that 1, 2, 4 times. So you click on this, it comes over here. And you got to do that 4 times. One time will be just 1 deviation up, 1 deviation down. The second one will be 2, 3, and 4. And then you change the colors to whatever colors you want. And then every single time you got to change the middle one to white. So that's what, for, so it stays the same color. And it will look just like this on the weekly and the daily. And you could do that for free.
All right, great. Thank you for explaining that.
Yeah, again, speaking of which, the CCI, look at the slow stow. Now we're in extremes again. It could stay down here for a while, just like right here. It's coming down, extremes. Came up a little bit and then hit the extreme again, and then we ran. So CCI is still going down, just telling me, here's support right here. Let's see where we are. I'm glad. See, this is what I like about this, doing this class sometimes. It's like, oh, wait a minute. So we have support right here also. Okay, we're right at that support right here. So we either found the bottom and now we're on our way up, or we're going to go down a little bit farther. So it's going to be an interesting week. Tell you the truth, I think we're going to come down a little bit farther yet, but I think we're getting really close to breaking to the upside for November. So, okay, guys, now I got to go. Really do. So, you guys have a good day and good weekend. Take some time off and enjoy families, friends, and come back refreshed Monday.